Hi, Mike Swanson here. As you can see, I'm kind of almost on a vacation, but I am still doing a little bit of work. I know this is New Year's a couple days ago, and January the 4th is actually my birthday. And it's a time of year that, I almost always sit back and look back on the year before and then look forward to the future in life and also in business in the stock market. And I know most people use this time of year to try to make New Year's resolutions. They might be trying to lose weight, or they say they're going to exercise more, stop smoking, or something like that. But that's not really what I do. What I tend to do is, like I was saying, look forward on what I've done, and then, think about what the things I want to accomplish this year. And when it comes to the stock market, that means trying to see if anything's happened in the market and trying to analyze the trends and look where I might be making money this year and in the market, what I'm going to need to focus on. And that's what I really want to talk to you about today. And I put together a presentation I made the past day or so, where I just kind of step back to the market and use this time to do that and put this together for you. So let's go through that together, and I think you'll get a whole lot out of it.
Okay, this is part 2 of my 2-part series on how to make money in the stock market in 2009. This presentation is going to be about knowing when to buy a sector at the start of a new bull market for that sector, instead of just buying now or buying whenever, not knowing what you're doing, and guessing and then praying. That's not what I'm interested in. I'm interested in buying something with expectation that it's going to go up over the next couple months and I'm going to make a lot of money. I'm not interested in buying on the way down thinking, oh, it's dropped a lot, so I'm going to try to buy now and roll the dice because it's down and I want it to go up. That's not how you make money in the market. That's how you get nervous and you put yourself in a very stressful situation that's frankly not any fun. I like to buy and have things go up because it's fun, not because I like to gamble or do some silly stuff. So anyway, to me, successful investing means aligning yourself with the broad market trends, and that means stage analysis. And I talked about that in part 1 and how to identify the beginning of a new bull market and what happens between bear and bull markets, because I believe this period of transition is what we're going to see happen at some point next year if it hasn't already began already. But anyway, for a quick recap, this is stage analysis. This is a stage 1 consolidation phase that comes at the end of a bear market, and that's what we're going to be seeing this year. If we're not right here, then we're right here in that trend. Stage 2 is the bull market. Stage 3 is the top. Stage 4 is the bear market that we saw last year. This is the 150-day and 200-day moving averages. You can see the pattern and way they are during these stages. In stage 2 bull markets, these moving averages tend to act as support. In bear markets, they act as resistance of prices below them. And in consolidation periods, what happens is the price and the moving averages at some point come together. The moving average flattens out as you get sideways action, which prepares the way for the next bull market. Now, again, I don't guess bottoms. Why? Because it's uncertain, it's risky, and I like to buy at turning points when I'm sure things are going to go up. And I talked about how you can do this for the broad market in part 1. In this part 2, I'm going to introduce you 2 important concepts that you can use to buy individual sectors at the right time. This is going to be critical for this year in a time of transition from bear to bull market, and it's going to mean huge opportunities, because what you're going to take away after you finish listening to me today is you're going to know when to buy and what to buy. 2 important things. That's all you need to know to make money. The problem is people don't know how to do that, and they just try to guess bottoms in random stocks and sectors. And oftentimes these stocks and sectors aren't the stocks and sectors that lead during the next bull market. And it's nice to see the market go in a bull market and go up 30% a year or whatever, but the top sectors in those times go up a lot more, and the top stocks in those top sectors can double, triple in value, and even more than that. And that's how you make big money in the stock market. You can make money trading, and that's what I've done the past year by shorting at the right time and so forth. And I'm still going to do that probably this year in the first part of the year. But in the big picture, the big money to be made in the stock market is done so by buying and holding the best sectors the best stocks and the best sectors when they start new bull markets. So, two important concepts. The first important concept you're going to learn about today is the importance of relative strength. What's relative strength? It's how well a sector or stock is performing compared with the rest of the market. You figure this out in a simple method. You take the price of the sector, you divide it by the price of the market, you plot this out in a chart, you're going to see a line that is either rising or falling. It rises when that sector is outperforming the market. It goes up more than the market when the market goes up, and it goes down less when the market goes down. And that's what you want to get in those kind of situations, because that's where you make lots of money. When you outperform the market in a bull market, you make lots of money. When you outperform the market when the market's falling, you save money. That's how you get ahead in the stock market. And relative strength is one of the key concepts to do this. And that means you're going to sort the sectors in the stock market and rank them by performance. And I use TC2000 software to do this. There's other software that can do this too, but I found this to be the simplest and easiest to do. And by doing this, what I look for is strong relative strength during market declines, because the sectors that hold up during market declines and towards the end of bear markets usually are the first to lead the market out and begin bull markets ahead of everything else, and they end up being the best performing sectors over the next 12 months. And again, this is TC2000. I know you can't see it that well in this video, but on the right side is the 239 sectors in the entire stock market. It breaks the whole market up into these sectors, and then you can rank them by relative strength, and it's really quick and easy to do. You can also rank them by any time period. You do like a 5-year rank, 1-year rank. Let's just do from July, the top in July, and see what happens. And you're going to see that the very top sector is major airlines. After that, it's regional banks, insurance companies, education, home healthcare, auto parts stores, and so forth. What are the worst sectors? The sectors that you definitely do not want to be a part of: healthcare, mortgage investment, broadcast, oil, steel, construction, aluminum, copper, marketing service, investment brokers, and so forth. But again, the best sectors: healthcare, banks, so forth. So anyway, that's sector rankings. And I'm going to show you some examples of what this means. In 2001, this is a chart of AutoZone. And the market had a temporary bottom in March and rallied up into the summer. Then you had September 11th happen. That's the broad market. But AutoZone, if you recall, the stock market as a whole topped out in March and had a vicious decline. Well, AutoZone didn't follow the rest of the market. Instead, it went into a sideways stage 1 consolidation period. And during that time, since AutoZone wasn't following with the rest of the market, its relative strength was trending up. And as you remember, stage 1 base means sideways consolidation with the moving averages flattening out. That's exactly the pattern you saw of AutoZone. And when the market made a temporary bottom, AutoZone broke away from everything and went to a bull market of its own, and had an incredible run. Was one of the top stocks of the entire year. It might have been the top stock in the S&P 500. Not sure exactly, but AutoZone was definitely my top stock that year, and I pounded the table on it. And let's go to another example, gold stocks. And this is actually when I first got into the gold stock market was 2002. In the first quarter, and the same pattern happened. Gold stocks are in a stage 1 consolidation phase. Again, stage 1 is what you get after a bear market. Sideways consolidation, moving averages flattening out. And that's what happened with the gold stocks during this time. And they broke out in February and went on a nice bull run. The price for the HUI Gold Stock Index doubled in value, while the top gold stocks in the sector tripled in value. Some of them even went up more than that. Now let's zoom to 2003, the start of the last cyclical bull market that ended in 2008. Began in spring of 2003 and ended in 2008. Well, one of the top leading sectors during the entire bull market were oil stocks. And what do you know? Oil stocks displayed strong relative strength towards the end of the stage 1 consolidation period for the broad market that began in 2002 in July and ended in 2003. And bam, what do you know? This energy stocks were among the top performing sectors during this time. 150-day and 200-day moving averages acted as support, as they tend to do. Well, let's look about right now. What's going on right now? Well, since July, the top performing sector, you recall, was airline stocks. Well, what do airline stocks look like? Airline stocks have been in a stage 1 consolidation phase. Relative strength has been trending up. Stage 1 consolidation phase, while the rest of the market has been declining. If you recall, you had a vicious stock market crash in October and new lows in November. Didn't happen to airline stocks. In fact, airline stocks have been going sideways. And they're telling us that they're most likely going to be one of the top sectors for the entire stock market when we look back 12 months from now. Well, I'm telling you how to identify the top sectors, how to identify the sectors that are most likely to go up over the next 12 months after you've seen the market have a correction or after you've seen the market reach near the end of its bear market or is in a consolidation phase. So this is how to identify what to buy, what you want to be involved in, where you want to go and put your money. Second question, though, is timing this. How to know when to put your money at work. Again, we can look at examples from the past, and I'll do that with you in a second. But the key indicator I use to do this is the 200-day Bollinger Band. I also use the 15-day, the 10-day, the 20-day Bollinger Band on a long-term basis to time entry points. But when I want to time long-term entry points, I use the 200-day Bollinger Bands because it's really looking at a big trend. And again, I'm going to show you this examples from the past and the airlines right now. What the Bollinger Bands do, though, is they measure the volatility in a stock, in a sector, in the market. And when the Bollinger Bands shrink, that means volatility shrinks. Volatility shrinks when the highs and lows become closer together. And what's happening is that the selling and buying pressure is becoming compressed. And it's like if you take a coiled spring and put one side, the bottom of the spring in your left hand, the top of the spring in your right hand, squeeze it together, you're putting pressure on the spring. Then if you take, let's say, your right hand off the spring's going to jump out of your hands. Well, that's basically what happens in the securities market. Volatility shrinks when the buying and selling pressure becomes equal. Then bam, volatility expands when one of these pressures is taken away. And when you have the transition period between bear and bull, what that means is the selling and buying pressure after bear market becomes equal. The selling pressure is pretty much alleviated, but buying pressure hasn't gotten too crazy. People aren't too excited. So you see the sectors and stocks go into a trading range. And as that trading range period comes to an end and you make the transition, the final end period from the transition phase from bear to bull, which on this chart is right here. At this point, the Bollinger Bands come close together and you get a break through the upper Bollinger Band. So I really don't try to buy too much in this time period with the intention of holding. I might do some trading, but not buying and holding for the intention of holding for 6 to 12 months. Instead, I tried to do that here, which at the optimal point, and identify the optimal point by looking at the Bollinger Bands. I look for a break through the upper 200-day Bollinger Band after a stage 1 consolidation period. And if the Bollinger Bands come together, then you really know that this is about to happen. You don't always know it's about to happen, but if you look for these patterns, specific patterns, you can. Here's AutoZone and break through the upper 200-day Bollinger Band. You can see that started the new bull market, and the upper band actually acted as support. Most of the time, though, it acts as resistance. For instance, with the gold stocks, here you can see the Bollinger Bands came together. And when they come together like this, they're telling you that the big move is about to begin. So you don't have to guess when it's about to begin. You can tell it's about to begin in a couple weeks. There's no need to guess bottoms like everyone else does when you can just wait for the patterns to tell you now's the time to act. Because now's the time to act, because now's the time when the big move is about to begin. Then that's what I like to look for, and that's when I like to put my money to work. I'm not interested in buying into stuff with the hopes that I'm guessing at the right time, or that I think, oh, this has to be the bottom because things are down. That's what the masses do, and it's a bad strategy. Instead, I don't need that kind of stress. I don't need to do that to make money. Instead, I can wait patiently and wait like a lion, wait for things to line up, and wait to pounce when it's time to pounce and make lots of money, and it's fun, So anyway, let's look at oil stocks. Here again, the oil stocks, the Bollinger Bands really got constricted and really tipped us off that oil stocks are about to enter a new bull market. And what do you know? This is starting to happen in the airline stocks. And if the pattern plays out, you can expect the airline stocks within the next 6 weeks to break through the upper 200-day Bollinger Band and begin a new bull market of their own. The only thing that would hold them back is if the broad market itself collapses all of a sudden, which it has the potential to do that, because I'm not, as I explained last week about the signs to look for during the transition phases and how to interpret the broad market moves, there isn't any clear evidence that we can point to that we've actually had a bear market bottom. What we know for sure is that we're going to have a transition period. It could be that transition period's beginning right now, but if the bear market's still in full force, surprises come to the downside. And that's what could derail a bull market in airlines beginning right immediately. But even if it doesn't begin immediately, I'm convinced at some point over the next couple months it will begin, and this is where the best opportunity to make money on the long side is right now in the stock market, is in the airline sector. And as you can see, the moving averages are flattening out. You've had over 6 months of basing, and the Bollinger Bands coming together, and relative strengths coming together. So everything that you want to identify these patterns is coming together when it comes to the airline sector. Now, conclusions, strategies for 2009. One important point you need to realize, though, is that right now this is the only sector coming together, as I explained last week. As you get halfway through the consolidation period between bear and bull for the broad market, more sectors will line up as the airlines are lined up now. As you reach the end of the phase, lots and lots of sectors will line up to be lots of opportunities. The key, though, is to prepare for this. And that's why I'm telling you and giving you this material right now, because I want you to be prepared for these opportunities. There are opportunities right now in airlines. I've bought airline stocks. I've highlighted the individual stocks for the paying subscribers. There's going to be more opportunities as the year goes forward for us, and I'm going to be highlighting those opportunities too for the paying subscribers. And when I buy individual stocks, I tell people about them. I talk about the technical and fundamental basis I use for doing them. Then I also tell people when I sell. So that's really unique and really different from what most services provide, because most people just say, here's what's happening, here's something going up, buy, I'm buying. And they don't really tell you the methodology behind it. They certainly don't tell you when they sell, which is what I do. And so I really believe that now is the time to prepare yourself for this year. And that means educating yourself. That means going through the material that are given you for free. And if you're really serious, it means taking the Stock Market Mastery course. And if you're paying subscribe that's gone through the course, it may mean going back and reviewing parts of the course that are important, because there's a lot more to the course than a lot more information that I've been able to give you in these two videos. And if you're not a Power Investor member, not a premium member, it means signing up when you can and taking the course and getting yourself ready for this coming year. And because there's going to be huge opportunities. I think this year actually has the potential to be one of the best years for us ever in the stock market, because these are the right times to buy. Right at these moments when you start a new bull market is the most profitable time to ever enter anything when it comes to individual sectors of the market as a whole. And at some point that is going to happen this year. Even if it doesn't happen for the broad market, it's certainly going to happen for a couple sectors. And the sad matter of fact, though, is I know last year was a tough year for most people in the stock market. The average mutual fund was down over 35%. Lots of mutual funds were down 50% more. It was a slaughter across the board, not just for individual investors, but for the professional investors, for the mutual fund managers, for the thousands of hedge funds that are shutting down right now as we speak, and didn't apply real risk-reward methodologies when it comes to portfolio management, and really didn't have any real strategies except for following the herd. But I've lined out real strategies that work that you're going to be able to apply this year. And the thing is, if you got damaged in the market last year, if your account, the biggest loss isn't the loss of money, or the loss of value in your account from holding, or from trying bad strategies of guessing bottoms that weren't there too far ahead of time or whatever. and losing from that. The real damage people are going to suffer isn't the lost money, but the mental damage that they've received that's going to prevent them from taking advantage of the opportunities ahead of us. And what happens to most people is they get distraught from what happened to them in the market. They bury their head in the sand and kind of give up. They stop looking at their statements. They lose confidence in their abilities to make money. And instead, the real thing they need to take away from next year isn't losing faith in the stock market or ignoring, the opportunities in the market to make lots of money. They didn't go away at all. There are opportunities to make lots of money last year. The opportunities are always there. But to take advantage of the opportunities, you have to know how to do it. And I hope that that's what you took from last year, is that lesson. Because the reason why I'm successful in the stock market is because I learned that lesson myself. When I first started out investing, I lost money, and through the loss of money, I came to the conclusion that if I really want to make money in the market, I had to educate myself and apply strategies that are appropriate for the broad market trends and align myself with those trends with the right strategies at the right time. And last year that meant short selling, but this year at some point it's going to mean a buy and hold strategy in the top stocks, in the top performing sectors that enter new bull markets. And I've lined out exactly how to do that with you in this video, in the video before this. So I hope you learned that and you listened, and you're going to apply this to this coming year. And I hope to see you in the premium section, member section of the website, and communicate with you there, and that we're going to be able to profit together in the coming year. So be talking to you later.